I uh I do that kind of stuff too, just in case you guys were wondering. Cinco de Mayo indeed, Russ. How are you? Hey Hank, how's everyone doing? Hope you all had a great weekend. Um, we had a very rainy weekend here, pretty much soaking wet the entire time, so not great, but at least it's warm. I guess I'd rather have some rain and some sun mixed in than, the freezing cold tundra. Hi, Dorley. All right, I'm sorry. I'm just pulling a couple updated charts here that I wanted to toss in real quick. Grab that here. Oh wow, Q's already filling the gap. The optimism might be continuing here. Okay. First of all, let me just make sure everyone can hear me loud and clear. Let me know. Um, so make sure we're all good there. Which XLU, Russ, are you referring to? You took the income machine one? Um, so sometimes I have so many different things going on that it's hard to always track which which thing we're talking about. Okay. Sorry. Yeah, I've got a lot of monitors going on. Yeah, well we've Russ, we've got a good amount of time on that one. That one is May 16th. So no, no action or anything there yet for me. I will let you know obviously if we get closer and we get to a point where there's some action required, but we're giving that one some time. XLU dropped a little bit. We'll talk about that. XLE taking well, if you're looking to get filled, you'll get filled at a great price if you want to trade the XLU. Pastor Levine, Denise, hello. Jackie, hi. Andy, hello. Uh, Rob, hello. Mike. Okay, cool. Well, it sounds like everyone can hear me. We're gonna get rolling. So today, I'm not going to cover a ton of the prediction stuff when I'm looking at because I'm going to cover that all at 1 o'clock with Roger. Hopefully, everyone will be there live with Roger and I. Got a couple bold predictions I want to talk about on at 1 p.m. and kind of give you guys my playbook for the rest of the year there. So today I won't go into too much of that. Today I'm going to focus more on the premium collection, the covered call side of things. 'Cause I've been getting quite a few questions because over the last few weeks I've said, hey, when the market is dicey like this, a couple things that I do. One of them is to trade covered calls or sell premium, and so I've got a couple questions on how to do that. So I ripped out one of my old trainings here on selling covered calls. I want to keep this today more focused on that if you guys have questions and all of that kind of stuff. But before we do that, let's just talk quickly about where we're at, kind of our head start out of the gate here, what's leading. Interestingly, it's really XLE and XLU that pulled the market down a little bit today. I mean, nothing extreme. The Qs hit -1% at kind of their peak. I guess that was around 8:30 this morning, and 1% on the QQQ is really not a big deal right now, which you kind of have to adjust to that new normal where a 1% intraday move or overnight move is really not much to make any noise about while the ATRs and the volatility are still where they're at. Now, I do think they're starting to come down and we're going to get a more of a normalization, but they were down, I think peaked 1.05% maybe, and are basically, 0.3, 0.4% right now. So already back into a very normalized move, but they weren't being pulled down by XLK and really even XLC, just down a fraction. It was really consumer staples, energy, and then some discretionary that pulled the market down a little bit this morning. And the rest of the sectors are still pretty healthy. Financials gap down and then kind of filled the gap. Tech gap down a little bit, filled the gap. XLI, which the income machine called last week, was a juggernaut since mid last week when we got it. And then health, like I said, a little under neutral, but we're not talking about big yanks down. And so for me, when I see this kind of movement in the sectors, I think everything is normal. We're not getting any kind of crazy moves in one direction or the other. We're not seeing liquidity getting yanked out of all of the technology stocks or all of the communication stocks. Very normal, kind of shaky volatility Monday so far. Income machine play we have today is on XLF. XLF has made the income machines list here about 3 times in the last 4 weeks. It is once again today. And so here is the trade I'm going to give you for today, going out to May 18th. Now, don't worry. In the next probably 10 days, I would say, in the next 10 days, I will be able to actually take you through the income machine. Instead of just giving you a random trade, I'll be able to actually walk you through what's going on with the income machine, how it's pulling all the data, how it's giving different expirations and different strikes based on the best income opportunities, all that stuff. So this is not just going to be an ongoing, you only see a scratch. I'm going to be able to walk you through all of the nuts and bolts on how it works very soon. I just want you guys to know I'm not holding out the surface level version on purpose. We just need to finish a few more things, and then I'll be able to really walk you through it. And it's incredible in my opinion. And so I'm very excited. So again, just so you know, this is not me only showing you something because I want to hold it secret. We will get into it as soon as we can. But for now, I just want to give you value from it in the meantime. And that's why I'm trying to give as many trades as I can. Here is the one that the income machine likes right now. It's XLF going out to May 18th. Basically, if XLF is above 49, so anything above like 0.5% positive from where we are right now, it's about a 40% return, which, those are numbers that I would certainly take anytime. Did any of you take the XLF, XLI? I think we had one on XLU in the last little while, because that has been May 16. Yeah, sorry, that should say May 16 there. Thank you, whoever Dave, for calling that May 16th. There you go. John, Andy, you're right. I don't know where 18 came from. May 16th is a Friday, so we've got 11 days for XLF just not to fall more than 0.4% or whatever. I don't know exactly the number it's at right now, but somewhere in that range is what we're doing. And these are really the kind of plays that the income machine is going to try to find for you. Now, the income machine will automatically give you opportunities and let you choose whether you want to be aggressive, medium, or passive. So basically, it's going to automatically give you those designations and let you choose whether you want to get an 80% type of ROI, maybe, or something more aggressive like that, or 15 to 20%, or you just want to go for 5-7%. And then it's going to search the option chain and find the highest probability trade that it can find within the metrics that you're choosing. So right now, I've been going for more of the moderate ones, a couple weeks out, try to get, anywhere between 30 to 50%. But I've also done a couple of the, shorter time frame, 15 to 20% ones. I'm really just trying to experiment and trade as many of the different opportunities that it's going to create as possible. But it will give you a lot of range and kind of let you choose your own adventure, so to speak. As a matter of fact, if you look here, you don't even have to take the suggested one. You could say, XLF looks okay, but I'd rather trade XLP. You could click through XLP and it would give you the different opportunities for XLP based on what you like. So it has a lot of, like I said, choose your own adventure baked in, because it's going to look at all the option chains for everything. Now, like I mentioned last week, these are trades that I'm planning for the most part to let expire, which is very different than if you guys trade overnight options with me, automated options, two-way, pretty much anything that I usually trade, I would use a target on any kind of spread. What I'm trying to do with the income machine here is set up more trades that I actually let them go. Because remember, the entire way the engine is working, the option engine and income machine that we've been building is working, is to find probabilities. And the way that it's defining probabilities isn't based on me choosing a target. It's based on where price is relative to where it's expected to finish. And so I'm trying to just let it do its job in that way and not get in the way with any targets and test it. Now, I might refine it and come up with my own version of targets or put a target on half my contracts and let the other half expire. I'm still working on all of that. But for right now, I'm testing it, kind of letting it do its job and me staying out of the way as much as possible and seeing, how well this thing performs because so far the data looks incredibly impressive. And so I just kind of want to keep my hands off for now during this testing phase and let it go to work. So for all of the income machine plays for right now, no target. We're just letting it. If you see here, this bottom, that's what this is saying. If it expires, well, we win above. If it expires below, we lose, and then just kind of let it go to that. Okay, so hopefully that makes sense for everyone. Couple earnings that we have this week. Big one today after market close is going to be Palantir. Obviously, not just a big tech stock, not just a huge outperformer, but one that the retail market loves, has a lot of attention. Should be, very interesting to see what Palantir does, and not just that, but the market reaction. It's like a Tesla type stock. I don't just care about the earnings or the performance. I really care about how the market reacts to those numbers. Because Palantir is a good example of there's going to be millions of people who care and are paying attention. And so the reaction gives you a little better gauge on where things are at in the market than, a stock that people just don't really care about, even if they post good numbers. And right now, I think the market's very optimistic. In fact, like I shared last week, maybe a little too optimistic for my liking. I really like the fact that it's going to be bullish, or that it's been bullish, since the bottom of whatever that ended up being late March. Great. I mean, it's made a huge recovery, but it seems like it's maybe gotten a little over its skis, and that's going to be interesting, obviously, for what that means. Do we get another flush in between? We'll talk a lot more about that at 1 o'clock. Okay. Eric, if it expires above that number, if XLF expires above 49, it will be worth $1. So to make you a 41% return if it expires above $49. All right, so that's what a $1 spread is worth on a debit side if it expires above that number. It's worth $1. We also have AMD and Supermicro here, these two. Rivian, by the way, is another one that retail loves. I don't know. It's going to be interesting, folks. It's going to be interesting to see some of these stocks that underperform but retail loves, and kind of what the reaction is, because the market is so resilient and optimistic all of a sudden since the lows that even Tesla, obviously, that put up bad delivery numbers and pretty bad earnings numbers, got actually some positive follow through. Carvana falls in that category as well. It's kind of built up a retail consumer base and an institutional consumer base since it had a 98% drop and has been a great stock since then. So lots of interesting ones. Coinbase, obviously, as well. Coinbase coming off a mega monster beat that I thought they would have in Q1, and they dropped 40%. What's going to happen now? Do they, beat and go down again? Do they underperform but rebalance back out to a reasonable expectation? Super interesting one. So if you think about what this week has in store for us, it's very different than last week. Last week was the true mega caps that are going to determine what the market does. The Microsoft, Apples, Amazons of the world. And this week is more like the retail fan favorites and what kind of reaction they get. So very different dynamic that are going to tell us very different things here this week compared to last week in terms of earnings announcements and what the reaction is there. But these are the couple that I'll be watching that I think will be interesting. I might even play a little two-way on Palantir, depending on what the expected move is today. A couple reminders I always try to give you. Members, you can email me directly. It's Monday, so I'm, of course, catching up on those from the weekend. Make sure you're in my Telegram. If you're not in my Telegram, that's where you get the most active updates, all the stuff that I'm doing. And then, of course, just make sure that you're on my text list, that you have your phone number in that form, because that's where you get my stock of the day each day directly to your number. Eric, was it Eric? Yeah, you're pocketing the time decay either way. Here, I'll post it one more time for those who ask. This is you're pocketing time decay either way on this trade um, if you're under the price. So this is what a lot of people don't totally understand because there's confusing messaging about debits and credit spreads out there. But I'll just draw it for you real quick. It's helpful to understand. If you put a spread here and price is up here, it doesn't matter if it's a debit or a credit spread. Doesn't matter one bit. You're collecting time decay either way. It's just one that you're paying up front and then getting the potential ROI of the full value of the spread. The other you're collecting premium up front and then you want it to expire worthless. Either way, it's the exact same trade dynamic. The risk rewards are the same. All those are the same. Unfortunately, people in the trading industry thought it was really fancy to say collect income all the time with the credit spread thing, and they made people believe that a debit spread doesn't take advantage of time decay, but it's completely backwards, folks. You could do a credit spread below that collects zero time decay and a debit spread below that collects zero time decay. You can do a debit spread above that collects time decay and a credit spread above that collects time decay. The debit versus credit designation makes no difference whatsoever. It's only about where price is relative to your trade structure. And so in this case on XLF, we're above price. And so as long as it expires above this line, the $79 line on the spread that I just gave you, it will expire. It will then exercise for a full dollar. So we paid 71. If it expires above this level, then it'll be worth a dollar. And then you get your 40% ROI. That's the exact same thing as a credit spread. The difference is on a credit spread, you would collect 29 cents and then it would expire worth zero and you'd keep the 29. But hopefully you guys can see these numbers are exactly the same. Here you collect 29 cents because it expires for a dollar. Here you collect 29 cents because it expires at zero. But the trade is identical in every sense of the word. Same buying power, same risk reward, same scenario. It's all the same. I just like debit spreads because they're easier on the math and you don't have the early risk of assignment. But everything about the trade functions exactly the same. And again, the only reason that people think it doesn't is because they have bad training from people who said things like, "Oh, credit spreads is how you take advantage of time decay." But that's not true. It's just a matter of where price is relative to the trade. So just so you know, we'll do a whole separate class on this because I'm now. By the way, I'm not being hard on anyone. This is what everyone thinks because everyone's been taught wrong about this because saying collecting premium sounds good to the ears. And so people say, "Oh, yeah, that sounds great." And then in reality, they really confuse how the trade actually works. So I will do a whole separate class on how spreads actually work and how it's all about where you are relative to price and nothing about whether it's a credit or a debit. You could just choose that based on, really anything else. So I will do an entire class on that. I'm not beating anyone up because this is what everyone thinks, but it's really good to finally actually understand the real reality of how spreads work because then once you understand them, you can set up your own different scenarios in terms of risk reward and ROI, which by the way is what the income machine's doing just with an algorithmic setup and looking through every spread available and doing it. But I will show you how to do it. Yeah, I posted it again, guys. It's May 16. I just posted in the chat. You can see it right there, May 16. Oh wait, I only posted the update. I only posted the bottom. Sorry, here, May 16. May 16. Sorry, I'm talking and typing at the same time, which is never a good idea. May 16, next Friday. Sorry about that. I don't know. I was typing in a fury before we started and obviously put the wrong date there. Yeah, I've got a ton of feedback about this. Questions like, are debit and credit spreads actually different? Which one's better for collecting income? Which one actually has the risk of assignment? Do you always close it together? Should you close it separately? Can you combine debit spreads and make condors out of it? All these questions will be answered with a really good understanding of just how spread structure. At the end of the day, the way that spread structure is where the price is relative to where current price is and what the expiration scenarios are, and then understanding risk reward, understanding the value of the spread versus what you pay for it, or the value of the spread versus what kind of credit you get. Once you understand those two things, price scenarios and risk reward scenarios, the whole world of trading spreads opens up to you. So I will try to get that class on the books and really give people a deep dive at some point in the near future. It's gonna take a little effort just because I really want to do it well with good visual understanding and lots of good examples so you guys can really have those light bulb moments. Because I promise you, once you have a few light bulb moments, the whole world will open up to you in terms of how you approach the stock market. Once you really get it, you can set up trades that you never realized were possible just looking at a stock, saying, "Hey, I want to trade Apple this way. How could I do it?" If you understand spreads, you can probably figure out a trade that creates every kind of scenario that you would want to do it. Now, speaking of selling premium, today's class is about. So today we're going to talk about covered calls because I have mentioned that I've been doing more covered calls when volatility is high just to give myself some cushion and all of that. And I've got a whole bunch of questions about how covered calls work. So I yanked an old training out to go through. This has a couple older examples, but all the principles are exactly the same. And I thought this would be helpful just to rip through today so that when I say something like, "Hey guys, I'm throwing on some more covered calls," with the market being wild, you guys know exactly what I mean, and you have a baseline for how I do it. So hopefully this will be helpful. I'll go through it, and if you guys have questions, just let me know. I probably won't look at the chat a whole lot just so I can go through it as concisely as possible, but I'll certainly circle back to any questions that you have here at the end. Okay, so the big question is, what is a covered call for those of you who are brand new to this? So a covered call is when you sell a call option on a stock that you actually own. Okay. So typically you sell one option contract per 100 shares of the stock you own, right? So if I own 300 shares of ExxonMobil, then I would sell 3 call options on ExxonMobil. Sell 3 calls against 300 shares. It's covered because a sold call is actually a bearish position. But of course, owning shares is a bullish position. So that's the cover. That's why it's a hedge. The calls that you sell are a bearish position, but obviously you own shares, which is a net bullish position. So in my position, or in my opinion rather, you should never sell a call unless you're executing a cover call. That for me, that's really the only time I would ever sell a call. There's just way better risk-controlled ways to short the market than selling naked calls, in my opinion. Take it or leave it, but that's my opinion. I would only use a sold call if it's a covered call. Now, what is selling a call? It's a contract to sell a specific amount of shares at a specific price at a specific time. That's what you're doing when you set up a covered call. So if I sell two $200 call options on Apple with an expiration of May 9th, what I'm doing is I'm agreeing to sell 200 shares of Apple at a price of 200 per share on May 9th. In other words, I would be short Apple with 200 shares at a price of $200 on May 9th if that were exercised. Now, why would I agree to sell shares at a certain price at a certain time? Well, extra income, hedging, and risk reduction. And by the way, you get a little increase of margin in your account as a side bonus. All right. So we could talk about a lot of different ways to use covered calls and how they could or could not be beneficial. But there's really one superpower, I would call it, that covered calls have that standalone that really no other kind of strategy has. Because when it goes according to plan, you can make an extra premium from the covered call without costing you a penny of upside on the stock that you own or want to keep owning. All right, so let's go through the example of kind of what the ideal scenario is. So imagine I own 1,000 shares of Ford at $9 a share, right? So I want to pull some extra income. Keep in mind, I'm not bearish on Ford. I still like it. I want it to go up, but I just want to double dip on it. I just want to make some extra income from holding the shares. Well, I can sell up to 10 calls because I own 1,000 shares with a specific expiration and strike price, which produces a credit in my account. So we'll get into some baselines for picking the options in a minute. But for now, let's just assume that I pick an option that's a month away and has a strike price of $10. So about $1 higher than the current price of, or than the price that I own of Ford. At the end of the day, this is very simple. I'm saying if Ford is above $10 1 month from now, my shares are going to be called away because I agreed to sell them at $10. But if Ford is trading for anything less than $10 1 month from now, then I'm going to keep the entire credit I received and nothing's going to happen to my shares, right? I'm going to keep the credit, but nothing's going to happen because it expired below that level. Now, remember, I said that we have one true superpower here, and this is really what it boils down to. Imagine if Ford does go up, but it ends up at $9.90 1 month from today. What actually happens on this position? I own shares at $9. I sold covered calls at $10, and Ford goes up 90 cents. It goes up from $9 to $9.90 in the 1 month between when I sold that covered call and when the covered call actually expires. So what happens? Well, this is kind of the perfect situation. So I owned 1,000 shares of Ford at $9.90. I now own 1,000 shares that are worth $9.90 instead of worth $9, which means I made 90 cents or 10% on my shares. So I made $900 in gains. Plus, I kept the entire credit from selling the covered calls, which is about an extra maybe $200 or so in this scenario. Yeah, 10%, probably less than that, maybe 150. But just for example's sake, because I don't really care about this exact situation, I'm just showing you the potential scenario. In other words, I got paid a bonus layer of income while not losing a single penny of growth on the stock if it goes up but still closes below the strike price. Okay, so that's the ideal scenario. Does that make sense? For a covered call, the ideal scenario is that it goes up but still below the strike price. That's going to be your best case because you make money on the stock, but you also make the full value of the covered call. Okay, good. Now, here's the thing. A lot of people look at the $200. This is what's kind of funny about covered calls, because a lot of people look at the $200 of extra income and think, it's not really worth it. $200 on 9 grand. I have to own $9,000 worth of a stock to make $200. That's not really worth it. But I find that very ironic because everyone seems to like the idea of a dividend stock that pays 5 or 6%. That sounds very attractive to almost everyone who's an investor. But 1,000 shares of $9 would have been a $9,000 stake, right? And then $200 is like a 2.2% ROI in 1 month, which is nearly 30% compounded annually. So for some reason, people seem to like the 5 or 6% dividend, but something that compounds to nearly 30% a year, they're kind of like, $200, not really anything to get excited about. Now, obviously, the caveat here is that the covered calls don't work out in the best case scenario every time. But imagine flipping a 5% paying dividend stock into 30% by using covered calls. Over time, the exponential impact of that is pretty extreme. It's actually pretty mind-blowing. And by the way, Ford's a pretty low yield example. We can actually target much more than that with stocks that have higher volatility because they have more expensive calls. Now, I like to use covered calls on my dividend stocks primarily because I like the idea of the double dip. It pays me a yield plus I get the covered call. So paying a passive income while also getting the premium on the covered calls. But there is a catch 22 with dividend stocks. See, dividend stocks tend to be great candidates for covered calls because they don't tend to move very fast. In other words, they tend to stay below that out of the money call more often than not. You sell a call 5% above or 6% above, and the dividend stocks don't tend to move 5-6% in a month, and so they typically stay below your covered call level, and you keep the premium more often than not. So dividend stocks tend to be good candidates for covered calls because they don't tend to move very fast. But dividend stocks tend to produce a smaller covered call payment because they don't move very fast. So that's really the catch-22 of using it on dividend stocks, is they're good candidates to keep your premium because they don't move very fast, but you don't get a ton of premium because they don't move very fast. And a key part of the options pricing model is volatility. So the more volatile stock is, of course, the more option premium you will have. And since dividend stocks tend to have lower volatility, the premium options tend to be lower as well. Okay, so that's the catch-22. And because we're selling the options, not buying them, we want the options to be as expensive as possible for a covered call strategy. So unlike, if you're buying a directional call, in this case, you actually want the options to be as expensive as possible. So if anyone tells you that dividend stocks are the best stocks to trade covered calls on, well, they might be right, but it's not because the juicy premiums, right? It's not because they're going to give you massive payouts. It's because they actually don't move a whole lot, and you're more likely to keep your premium on stocks that don't move a whole lot and therefore stay below that line in the sand. All right, everyone with me? All good? That's the catch-22 of. All right, cool. So just a quick review. Selling a call is agreeing to short a specific stock at a specific time at a specific price. That's really what the contract is doing. The options contract determines all those details. So selling a May 9th $200 Apple call means agreeing to sell 100 shares per contract of Apple on May 9th at $200 a share. A covered call is selling a call in the same stock we're holding the shares of. So you can't sell a covered call on Apple if you hold Amazon, right? It has to be on the stock that you actually hold the shares of. To cover the stock, we sell one contract per 100 shares of stock. If the stock ends up below the strike price on the expiration date, we keep the premium from this option and it doesn't impact our stock position because no one's going to exercise that. I mean, I guess I should say technically they could. They could just give you free money for no reason, but that's almost certainly never going to happen. In other words, I can't imagine, even if you sell covered calls for the rest of your life, that you'll ever be in a position where on May 9th, Apple finishes at 193 and someone exercises it and pays you $200 per share. And they just give you a free $7 a share. Technically, it could happen, but very, 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 very unlikely that someone's going to give you free money in the stock market. If the stock ends up above the strike price on the expiration, well, then you keep the premium, but your shares will be sold because now they are going to exercise because Apple's going to be worth 205 and they're going to take the shares at 200. So let me do a quick example. This is an old example, but still has the same idea of before. So this is Key, and the idea is, let's imagine that Key is trading at $15 a share, and I own 500 shares of the stock. Okay, so again, this is way back a while ago, but let's just imagine Key's trading at $15 a share today. Our total stake is shares times price. So in this case, about $7,500 on Key is what our stake is in order to get started. Now we can sell, in this case, the April 16th, the April 5th $16 call for about 32 cents a contract. Okay, so this was going back to April 2024. About 1 month out, we could get 32 cents a contract, which means $160 in total premium against that $7,500 stake, right? Because you're selling $32 per contract times 5, you get $160 in total premium. So $160 on $15,000 in shares, that should say, that's not $15, that should say 75. Sorry, my math is wrong here. But that's actually about 2% bonus over time. Now, fast forward and assume that Key is below $16. What happens if it finishes below $16? Well, nothing. You keep the 116 premium from the calls and you keep your 500 shares of Key, right? This is typically the best case scenario. In fact, if Key went up 5% during the next 4 weeks to 1575, you would make 375 on the stock and you would still keep the 160 premiums. That's that best case scenario. You make money on the stock and you make money on the calls. All right. So again, hopefully it makes sense. As long as it goes up, it stays below your call, you're going to make money. But let's go to the second example. Key trading at 15 share. We have $7,500 in total investment, and we get the same 160. Again, over 2%. I butchered my math here. Over 2% there on Key. And let's fast forward and assume that it's above $16. What happens in that situation? We sell 500 shares at $16, regardless of what price the stock is at, whether it's at 17, 18, 22, doesn't matter as long as it's above 16. We get called out of those shares. We keep the 160 of premium, and the rest of the shares get called away at the strike price. Now, we can't lose money on the out of money calls, right? Because it can only go up and make us money in order to get called out. So you can't lose money on the covered call, but you can lose out on potential profits. Let's say Key had earnings that went up to $20 a share. Well, now you're going to lose out on a whole bunch of potential profit because you're getting called out at 16. So your gains are capped. Now, again, the ideal scenario here is to pad our income with covered calls and not to be taken out of the trade. Now, in a minute, I'll show you the basic guidelines, but as a rule of thumb, you probably get around 1% a month. That example is actually closer to 2%, but in general, you probably get around 1% a month in premium. Now, the crazy thing is how much that actually stacks up over time. So let's stick with the $7,500 Key example and a 5.48% dividend. So that doubles your ROI in 10 years. Okay, so if you start with a $7,500 principal, you have 5.48% from the dividend over 10 years, you're going to get to right around double. Okay. You're going to hit that, 13,000 in the ninth year, get right around 100% ROI over the course of 10 years. Now, obviously, that's pretty good growth if the stock grows at all as well, because that's just the dividend, right? If the stock goes up 20% or 30% or 40%, that's going to be pretty great growth because the dividend alone is doubling your value over the course of 10 years. But the crazy thing is, while the 116 premium doesn't sound amazing in one contract, it's over 1%. It's actually closer to 2%. And if you just combine that with the regular dividend growth, the numbers are pretty crazy because over the same 10 years, we were at like a 90%, just under 100% growth from 7,500 to 13 grand. Now we're at like 500% growth. Okay. And that's just from the covered call premium over the same 10-year period. So compounding that 1 to 2% per month has a pretty crazy impact over the course of the year. And by the way, that's just going from 5 to 12, which it was way better than that. I just took a very, very conservative number and went from 5% to 17%. In reality, compounding it monthly would be much faster growth. So really that number, if things went in the ideal scenario, would probably be like a 10x of your account over the next 10 years from the compounded growth, which is pretty crazy. Again, when you just think about the simple compounding math over the course of 10, 15 years, whatever number it is. Now, obviously, it's unlikely you're going to go years without the stock exceeding your covered call strike, right? So it's very unlikely that you're going to go like 10 years and never be called away on the stock, but it still go up at all. More likely, every once in a while you get called out of the stock, you have to buy it again, right? That's the reality of how stocks move. But for me, it's really no big deal because I can't lose on it. And I don't mind just buying the stock again if it does outperform. Now, on average, I expect the stock to finish below the strike, meaning you keep the premium about 75% of the time as a good rule of thumb. Now, in super bullish markets, it could happen, more or less. It just depends. But again, I don't mind if it happens, 50% of the time, because what that means is that my overall portfolio is probably doing extremely well. And so I don't mind having this covered call portion with less risk when the rest of my portfolio is ripping in that same environment. Okay. Now, in fact, what I love about the double dip approach is it's kind of organically hedges itself for all these different scenarios. If the market is down, I get free padding. If the market's up, the rest of my portfolio should be producing really good returns while this is producing smaller gains. It really kind of sets you up automatically to play the middle of the field. All right, so let's talk specifics about what calls I would typically recommend selling. The guidelines are pretty straightforward, but I highly recommend you experiment and find your own comfort zone. This is one strategy you can afford to experiment because the risk levels are very low relative to other strategies. Just promise you'll inform me if you find the holy grail of covered calls. So my guidelines are all about finding a balance that generates meaningful return without restricting the potential of the stock. So basically, on average, 3 to 6 weeks out, 5 to 10% out of the money, and anywhere between 3/4, 1.2 on highly volatile stocks. You could, do 1.5 to 2.5%. It's just going to depend on how much volatility there is. So 3 to 6 weeks out gives you enough time to generate premium, but it's short enough that you can kind of roll with the trend. Okay, where the market goes down, now you're going to get lower strikes. The market goes up, now you're going to get higher strikes. It's a good time balance in between. 5 to 10% out of the money, it's tight enough to generate premium, but loose enough that you're not contracting all of the stock gains on a monthly basis. So you still can get good return if the stock goes up. And then this number is really just small enough to be possible, right? So it's small enough that with the guidelines we give it, we're not going to be able to get 5% premiums, but we can get 1.5% on highly volatile stocks while still giving the stock room to run 5 or 10% in a given month, which, like I said, is pretty good. And when you start doing the compounding numbers, it's a pretty incredible ROI. All right, so that's really my guidelines. If you guys have any questions, let me know. But hopefully that gives you a pretty quick baseline for all the people asking questions. Okay, Nate, you keep saying you've been selling more covered calls lately. What does that actually mean, and how are you doing it? Pretty straightforward. Hopefully this gives you a good primer for doing that. Robert, the XLF, you would pay a debit, and then if it expires above that $49 level, you would receive a full dollar in total credit. So you'd pay 71, you get a dollar if it works out, which is about a 40% ROI. Hank, yeah, I use IBIT on this. I use Tesla on this, or TSLL on occasion. I use several of my dividend stocks like Key and others. And I'm not going for home runs on selling covered calls. I use Coin. I collected about 25 grand on Coin because the premiums were so juiced up that I was selling massive premiums. So I collected about 25 grand in premium over the last few months on Coin. The only problem is it missed on earnings, so I was down about 40% on the stock. So you got to take that with a grain of salt, obviously. Reddit is another one I've owned and sold a lot of covered calls on because the premiums are high. Mike, either one. Mike asked a great question. Do I buy the stock directly back, or do I sell a naked put and try to get a little discount? It depends on where the market's at. Either one is totally fine. I usually, if the market is bullish, I will usually buy the stock so that I can just make sure that I own it, and I'm not going to end up only getting the 1%, but I have a chance at doing that double dip where I get value from the stock plus value from the call. If it's a dividend stock, I will usually buy it so that I can get the dividend right away. But you could definitely sell the put, and it works great because obviously you have all the margin built in when you do that. Really, any stock that you like, that you don't mind owning, that has enough IV to give you 1 or 2% a month, I think is a worthwhile stock. You have some higher premium ones like IBIT that Hank mentioned, Coin, those ones that I really like that are really outperformers on the volatility side, and those pay great premiums. Yep, no problem. Well, hopefully this gives you a good primer. You can always watch the recording; they're all on YouTube. If you go into the YouTube, you can skip through it, watch it on your own timeline. But hopefully this is a good primer for, again, when I say this is what I'm doing, I want to give you guys the actual tools and strategies for what that means and how I'm doing with these. All right, and by the way, guys, at 1 o'clock, I'm going through the bigger predictions for the rest of the year, where I see the S&P going, gold, a couple stocks that are on my hit list of touch versus don't touch. So that's 1 o'clock with Roger live. I'll send you a whole bunch of reminders over the next couple hours to make sure you get in the door. So make sure you take full advantage of that. The YouTube link for this is the Financial Wars YouTube link. So if you go to this link, I'll post it here in the chat. Bob, if you go to this link, and then if you just click the live tab there, it should show all the different opening playbooks, including the one that's live right now. So you can go right to that direct link, then click the live tab. As a matter of fact, if you just go to /streams, which is this link right here, it'll pull up those live tabs for you, and you can just go right there and click through all the opening playbooks and all that good stuff. All right, folks. Well, Cheers to another great week. Looking for an opportunity for where this market will head. I'll talk about exactly where I think that's going at 1 o'clock, and hopefully another great week of trading. Last week, I think was phenomenal. We hit a ton of winners across all different kinds of strategies, which was a lot of fun. Not every week's going to grind up 1% every day and be as fun as last week, but I think we do have more upside. Maybe a few shakes in between, but I'm pretty optimistic and looking forward to hopefully hitting out of the ballpark with everyone. Russ, yeah, I mean, commissions are going to be a big part. The biggest thing I can tell you with commissions is that if you just hammer your broker and tell them every chance you get that you want a better deal, you're ready to leave if you don't get a better deal, and keep trying to push them to reducing those commissions. That's the biggest edge that I think you can get. They pretty much reduce mine within reason every time I ask and remind them. And then if they kind of expire and bounce back up, I'll hit them up again. And sometimes I have to threaten to leave and take my money, but then they'll pretty much reduce them each time I ask. And for me, that's the best opportunity just to try to get that edge down. Because you're right, with as active as I trade, certainly commissions play a part in the overall performance. So I think if you can get down to about 60 cents on the commissions, someone asked what's good. If you can get down to about 60 cents, that's pretty decent. I know sometimes there's some better promos and deals out there. Um, I still have the 500 free trades from moving my money over to Schwab initially on one of my accounts, which is nice because it's no commissions still that I'm running on that one. But yeah, I think 60 is probably the number. If you can get to 50, I think if you're doing pretty good. Yeah, Jim, 30 per side. So 60 total is what I have on Schwab. Robinhood seems to be a little bit harder on the fills, but obviously I think they do the commission free, which backs it back out. So I think it ends up being fairly net neutral at the end of the day. John, I haven't done a lot of the synthetic ones lately. Um, that's a different trending. We could go into that. I was trying to answer that as succinctly as I could. I don't have an issue with it, but I think the idea of owning stocks that you really want to own regardless is kind of the safer, sounder way to build from there. But yeah, you can do it. Normally, Barbara, if it's free trades, I'll try to update in Telegram and on these sessions. And if people ask me, if it's an official trade, obviously it's in the track records. On all the free trades, I don't always remember to update every single one, but I try on these sessions to give you an update. And people will usually ask, hey, from the XLF trade from last opening playbook, is that still open? Then I'll look, oh yeah, that's still open. Waiting for it to expire and try to update you as much as I can. And then obviously any official trades opening, overnight options, automated options, those will all be in the tracker and have alerts so that you can, keep a very close eye on if those are open or not. All right, folks. Well, once again, I hope you have a great rest of your week. Looking forward to seeing you every day this week in opening playbook and especially at 1 p.m. Here in a couple hours. Talk soon.